Good afternoon, everybody. Welcome to the weekly wrap-up for Friday, June 17th, 2022. Hope everybody's had a great week out there. Pretty nice day here. It's a little warm and here in Colorado, but hey, at least there's no snow. It's weird. Less than a month ago, we had like a damn near a blizzard, like a foot of snow, broke a bunch of tree branches. And just a few weeks later, we had it up in the 90s, and it's crazy living out here. So anyways, all right. Well, if it's your first time watching, please give me a big thumbs up, a like, a subscribe, all that good stuff, because you want to be able to watch this every day and get notified when I do go online. So, but I'd call it a decent day so far in the market. Certainly it looks mixed when you are looking across the globe, but a little bit of a bounce back from yesterday. Oil prices receded, so that is certainly a nice thing to see. So let's go ahead and jump into today's numbers. The Dow Jones finished down slightly, down 0.13% at 29,888. S&P 500 was up slightly at up 0.22%, closed at 3674. NASDAQ up 1.43%, closed at 10,798. Small caps are up almost 1%. The VIX did pull back today, 5.52%, currently sitting at 3113. Moving on up to Canada, they finished down 0.39, Brazil down 2.9, Mexico was up 9.96. Heading over to Europe, Germany up 0.67, UK down 0.41. France was flat, finished down 0.06. Euro Stoxx was up 0.31. Netherlands was down 0.41. Spain up 0.84. Italy up 0.29. Switzerland down 0.23. Portugal down 0.11. And Belgium up 1.74. Let's look and see how the Russian markets did. The MOEX was down 0.67 and the RTSI was down 0.1. Moving on over to Asia, Japan finished down 1.77%, Australia down 1.76%, New Zealand down 1.14%. Headed over to China, the Shanghai finished up 0.96%, SESE component finished up 1.48%, China A50 up 1.75%, DJ Shanghai up 1.06%, and the Hang Seng finished up 1.10%. And the Taiwan weighted came down 1.25%. All right, so like I said, kind of a mixed day, but a little bit of a made back a little bit from yesterday on some of those equities. But again, looking at the longer term trend, let me bring up my chart here. We can look and see how the indexes did for the week. Dow 30 is going to finish down 4.08%. The S&P 500 down 4.29. NASDAQ looks like it's going to be down about 2.17%. Dow Utilities down about 8.68. And the Dow Transports looks like it's going to finish down 2.89% for the week. So looks like all of our major indexes are finishing in the red, some worse than others. But, is what it is. Let's take a step back and look at the long-term trend right now. Starting with, our peak right at the beginning of the year in January. Again, we've been in this long slide. We did break up above this momentum or this resistance line, twice now, first in March, and then we fell back below in April, broke back above here in late May, and then, the slide continued. So again, until we break this, downward slope, I would expect more of the same. Where it's going to bottom out, really have no idea. That's really not my specialty. I don't make those sort of prognostications. I mean, there's a lot of factors involved with how the economy is doing, how many people, how much revenue companies are making. So it, this could go on for a while, or it could be short-lived. Like it was, I guess, 2 years ago, where the bottom dropped out within about 30 days and recovered really, 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 really quick. But again, we know why that happened. You print $5-6 trillion, increase the money supply by 40%. It's going to reprice everything really, really fast. So we'll see. But anyways, all right. Well, let's go ahead and take a look at some of the economic data that came out this week. U.S. Initial jobless claims came in at 229,000. I covered that yesterday in an article. Forecast was 215. And if we look here, the line has been pretty flat for a while. We've been around that 200,000 number since late last year. So it has crept up a little bit. There's probably some reasons there. We've read a lot about companies laying off portions of their workforce. I think that's going to continue to get worse over time, but we'll see. Continuing jobless claims came in at 1.312 million. The forecast was 1.302 million, so 10,000 over forecast. But again, I don't really see that as being a huge problem at the moment. Something to consider is that job numbers are a lagging indicator. So, you'll see the economy falter. Companies will then start laying people off or go out of business, and then you'll see the job numbers creep up. So it's not you're not going to see, any of the damage or harm that's been going on right now really reflected in the jobs numbers immediately. So, all right. The producer price index year over year came in at a 10.8. Forecast was 10.9. So slightly below the forecast, but again, we can see producer prices are still quite high. And, a lot of that has to do with energy prices, making everything more expensive. Every time, you move a good from one place to the next, that costs extra. Turning on the lights wherever you're at, payroll's costing more. So until we see some relief here, I'd say first we see energy prices recede, then we'll see everything else come down throughout the economy. Retail sales month over month receded 0.3%. Forecast was supposed to be for a positive 0.2. So you can see that that's off by about 0.5%. So not real good there. This next one is housing starts month over month. You had a negative 14.4%. Last month's number was a growth. It says previous was 5.5, but it says here negative 0.2. So maybe they must have made an adjustment here for last month. But big pullback on housing starts. Again, not to be surprised. Interest rates going up makes the housing market, reduces the affordability for a lot of folks. If based on your budget, you can afford say a $2,000 or $3,000 mortgage, interest rates go up by, a couple percent at this point, at least on the mortgage rates. You're then going to see, that same house that you might have been able to afford for, $2,000 a month is now $2,800 when it's all considered with the increase in the interest rate. So, raising rates is going to price people out of the housing market for a short time until prices stabilize. I imagine in some areas they will probably recede a little bit. Hopefully not too much here for me. But again, I live out in the middle of nowhere, so I don't know how badly we'll be affected out here. U.S. industrial production month over month came in at a 0.2. The forecast was 0.4, so a little bit lower than what we were expecting there. The U.S. leading indicators index came in at a negative 0.4. That was right on forecast. So, not the best. The Baker Hughes rig count, we're sitting currently at 584 platform or rigs online right now. Previous number was 580, so we've increased that by 4. Again, we are still off by quite a bit if you look and see where we were in 2019 and 2018. So, and I think that's a big thing. I know the folks in the White House press room like to torture the current press secretary. And hey, I don't blame you. She's pretty bad at her job. But, to me, importing more oil from overseas doesn't make a lot of sense when you have it here in the ground. I know that there's a lot of leases that have been approved, but why would the oil companies want to spend a lot of time and energy into more exploration on those leases when they're being told out of the other side of the administration's mouth that they're going to have to go green and build electric cars moving forward. So yeah, I that is a bit of a disconnect. In one breath you're telling them, hey, we're going to put you out of business, and then the next breath they're like, hey, we could really use some more oil. So all righty, so that's everything there. Let's go ahead and read through today's market recap. S&P 500 climbs on tech rebound, but energy rout limit gains. S&P 500 climbed Friday as tech found some reprieve following its brutal sell-off from a day earlier, but a slump in energy kept a lid on gains. Tech, which is down nearly 30% year to date, helped the broader market steady amid tentative dip buying in big tech as treasury yields continue to ease off recent highs for a third straight day. Apple, Meta platforms up more than 1%. Led the gains for big tech. Adobe Systems, meanwhile, cut some losses to trade down 1% after the software market cut its growth outlook, citing a tougher macroeconomic backdrop, including the impact from the Ukraine-Russia war. Yeah, you gotta slide that one in there, folks. The stock is likely to remain under pressure, quote, until investors can gain comfort at the expected declines in Q3 net new digital media ARR and operating margin are transitional, and EPS, earnings per share growth, can return to growing faster than revenue, Oppenheimer said in a note. Consumer discretionary, which has come under increasing pressure on worries that a weaker economy is likely to squeeze the consumer, also racked up gains as investors piled into beaten down travel and leisure names. Carnival Corporation, Norwegian Cruise Lines, Booking Holdings, and Expedia were among the biggest gainers. Federal Reserve Chairman Jerome Powell on Friday reiterated the Fed's commitment to fight inflation and talked up the strength of the consumer, even as the slump in the stock market has made a dent in household incomes. Recent indicators suggest that private fixed investment may be moderating, but consumer spending remains strong, Powell said. The latest economic data, however, continued to flag building inflation pressures. Industrial production fell short of economist expectations in May, but rising utilization rates caught economists' attention. Quote, higher utilization rates correlate with higher inflation, and CU is not far off in the highs reaching the last cycle, Jeffrey said in a note. Energy, meanwhile, fell more than 7% after oil prices plunged on fears about weakening demand as recession jitters grow. In other news, Seagen surged 16% on reports the company has been in talks with Merck for a while concerning a potential sale. The rebound on Wall Street has sparked debate on whether this marks a relief rally that will prove short-lived or the makings of a prolonged move higher. Some on Wall Street have suggested the market is close to finding a bottom. Quote, likely more to go in terms of market challenge over the short run, but many of the metrics we track are closing in on levels that were associated with prior bottoms, end quote, Janie Montgomery Scott said. All right. So, yeah, I don't know about the whole, closing in on a bottom thing. I mean, it's, I've talked and reviewed, previous major downturns, 2008. I really don't count the one 2 years ago. That was helped out too much by, all the quantitative easing that was going on during that time. So, I would expect something probably close to a 50% drop in equities. But again, I go off the momentum of what's going on. So, but I wouldn't be shocked to see that sort of a fall in the markets. All right, next article: oil below 110 as U.S. recession fears strikes at energy rally. Is this the sell-off that cooler heads in the oil markets have been talking about? Crude prices tumbled 7% on Friday alone, with the weekly loss even larger at around 9%. The pledge came amid widespread fear that the United States was headed for a recession from the triple whammy of weakening macroeconomic data, inflation unyielding at 40-year highs, and a Fed determined to break the back of that with equally risque rate hikes. Quote, recessions are increasingly likely as central banks race to dramatically raise rates before inflation spirals out of control. Craig Erlim, analyst at online trading platform Owanda, said as the European Central Bank indicated 3 big rate hikes as well for 2022. Quote, it is better than the alternative, though, stagflation, end quote. While the world, particularly in the United States, was not yet in a stagflationary environment where prices keep rising while the economy continues falling, the term has, quote, been thrown around way too much in recent months, which perhaps highlights the trepidation around it, end quote, Erlim said. Quote, the risk of One is rising, which is why central banks are becoming increasingly accepting of their actions, tipping the economy into recession, end quote, he added. The last straw for investors is an overbought oil market. On Friday appeared to be a fifth monthly drop in U.S. factory output as firms struggled with supply chain bottlenecks and high costs, despite industrial production itself gaining. The Fed's divisional chief for Minneapolis, Neil Kashkari, meanwhile warned that the central bank might need to get more aggressive with interest rates if U.S. inflation doesn't retreat from 4-decade highs. That was a sign that June's 0.75 percentage point increase, the largest in 28 years, could be followed up by more major hikes, despite Fed Chair Jerome Powell's assurance earlier in the week that there were no more surprise-size hikes this year and that rate cuts could actually come as early as 2024. Boy, they're already talking about getting those interest rates down. It's just bothering those folks. The U.S. economy has already shown a negative growth of 1.4% for the first quarter. I think it was actually 1.5 that was revised. If it does not return to the positive for the second quarter, the United States will technically be in a recession, given that it takes 2 straight quarters of negative growth to be in a recession. Responding to that fear, New York West Texas Intermediate, the benchmark for U.S. crude, settled down $8.03 or 6.8% at 109.56 a barrel. For the week, WTI was down 9% for its first weekly loss since April. London traded Brent crude settled down $6.69 or 5.6% at 113.12. For the week, Brent tumbled more than 7% for its first weekly drop as well in 2 months. Let's see here. While the Ukraine invasion and subsequent Western sanctions on major energy exporter Russia had definitely exacerbated the global tightness in crude supplies, this year's rally in oil was beyond the affordability for many poor consuming nations, say analysts. In the United States, the best gauge of public burden from the rally was the pump price of gasoline or petrol that exceeded $5 a gallon first time since last week. Many pumps in the U.S., especially those in West Coast states like California, were selling at even close to $6 a gallon. The American Automobile Association said diesel was even higher in California at beyond $7 a gallon. Here it's like $5.30 for diesel. It's not inexpensive, especially when you put 76 gallons into a vehicle. Quote, "It's nuts when the bulls have what the bulls have been doing," said John Kilduff, partner at New York energy hedge fund Again Capital. Quote, "I know we have a global deficit in oil, but seriously, how much more do you want consumers to pay?" Kilduff said. Quote, "There's a limit to the supply tightness hype. I'm pretty sure that we'll be hearing cries over oversold from other side after this, and we could jump a couple of dollars or more after the weekend. This is a good reminder that there's still some sane heads in the market examining all the macroeconomic data that's coming in and reacting accordingly," end quote. Among that other side was Goldman Sachs chief commodities analyst Jeff Currie, who stood out as Wall Street's chief cheerleader for oil in calling for even higher crude prices before any real demand destruction could set in. Other oil bulls also remained unperturbed by Friday's sell-off. Quote, "Unless the economy goes into a total meltdown, those drops in prices should be opportunities to put on long-term bullish positions," said Phil Flynn, analyst at Chicago's Price Futures Group, who pointed out that the demand for oil during the most recessions had not fallen by more than 2%. All right. So again, my view on things is until energy prices recede, oil prices, natural gas, everything that makes the energy and turns the lights on and moves our vehicles around, until those prices recede, I really don't see a lot of pullbacks in prices or deflation in prices of everything else. So just because one touches everything, energy affects everything. All right. One last quick article here has to do with retirement savings. Way behind on retirement savings. Do this. It's written by Tanza Ludenbach, CFP. Ooh. Basically starts out with a scenario. I turned 58 this year and am at a loss on what to do or how to plan for my retirement. I only have a small amount of money invested through previous employers, and I'm not sure how to save now that I am self-employed. I'm really concerned about my retirement, but don't know where to get good, secure help. And this is answered by a financial advisor. excuse me, you are so close to retirement age that the best financial moves will be specific and deliberate. From how much you invest to which accounts you use to do it, you should also be planning for healthcare expenses and taxes and reducing or eliminating debt where you can. Here are several ways to boost your nest egg and eventual retirement income. First, max out your 401k and IRA and add catch-up contributions if you're eligible, which if you're over 50, you can. Consider delaying Social Security benefits to age 70 to maximize your eventual benefit check, assuming it's still there. I know we've talked about that a lot recently, that Social Security may be gone. Let's see here. Continue to work into your 60s. The more you can extend your earning years and push off your drawdown years, the better. Move somewhere with a lower cost of living, downsize your home, or trim your discretionary spending. Take advantage of tax deductions for self-employed people, such as writing off business expenses. Use tax advantage retirement accounts for self-employed people, such as a SEP IRA or a solo 401k, which have high annual contribution limits. And depending upon your situation, some or all of these tactics might be appropriate. All right, so all good advice there. Planning and saving for the future. The earlier you save, the easier it is. If you start out in your, mid to late 20s, you give yourself, like a 40-year timeline to save. Ideally, I would recommend folks save a quarter what they make. Another quarter goes to Uncle Sam for the time being, and then live off the other half. If you build that into your lifestyle, it becomes very easy. Well, not very easy, but it becomes easier as opposed to, if you're 45 and, you may be making a good living by that point, but if you have a lot of debt and you don't have any disposable income to set aside for the future, you're really putting yourself in a tough spot long term. All right. Well, that's everything I had for today. I hope everyone has a terrific weekend. I will be traveling the next week, so if anyone needs to reach me, there may be a little bit of a delay in getting back to you, but I will be doing so. I will be working while I'm at this conference. So, like I said, if anybody needs me, don't hesitate to reach out. You can go to dsafinancialgroup.com. All my contact information is there. And I'm not sure, depending upon where I'm at, if I'm going to have enough internet bandwidth to upload videos, so it may be audio. I'm not really sure at the moment, so we'll find out on Monday. So, like I said, hope everybody has a good weekend, and I'll talk to you then, hopefully. Bye-bye.